Good evening, everyone. This is Ishfaq Ahmed, having more than 25-year experience in the MNC companies in various disciplines. Currently, I am working as a Senior Vice President and CFO in Innovative Growth, dealing in the technology sector. I am a fellow member of Chartered Management Accountant, CPA, and I did the MBA also. This is my brief introduction. I am very glad and excited to share the insight regarding the financial instruments. I am very thankful to the management of IFA for providing this great opportunity. This is the agenda of my presentation, my webinar overview, IFRS 7 and IAS 32, IFRS 9, we will discuss in detail. But for understanding, we will start from the financial instrument definitions regarding how to segregate what is financial asset, what is financial liability. That in order to make a background, we will start from the financial instrument. Then we will move on the IFRS 9 classification, measurement, initial and subsequent, how we do the impairment, how we conduct, how we avoid the risk through the hedging accounting. One by one, we will discuss. Let's start from the financial instrument. What is financial instrument? Financial instrument, just a contract, just an agreement which generate between two parties, which generate for one party financial asset, for another party financial liability or equity instrument. Simple. It may be verbal, it may be written. For example, you made a sale and also send the invoice. Invoice is a contract, financial instrument. It generate for one party as a account receivable, for other party accounts payable. It means it generate financial asset for one party and financial liability for the other party. That is, it may be a verbal, it may be a written. You get the loan. The issuer of the loan is regarding as a financial asset. The who took the loan will record as a financial liability. It's very simple. Equity instrument, equity instrument just like another contract, which give a rise, which give the right in net residual interest in the entity after paying all obligations, after paying all liabilities. That is called equity instrument. There are two main components, financial asset and financial liability. We will deal in IFRS 9. Therefore, what is financial asset? We need to understand first. Then how to measure, how to classify, how to initially recognize, how to subsequently recognize. We will discuss in IFRS 9. What is financial asset? Financial asset, cash itself as a financial asset. Equity instrument of another entity is also a financial asset. And right to receive, if any contract which give you the right to receive cash or an other financial asset, that contract, that document will be called an financial asset. For example, you made a sale, you send the invoice. Invoice provide you a contractual right to receive cash from your customers. Therefore, receivable from the customer is a financial asset. On the other hand, who is receiving the goods, who is your customer, will record a financial liability, accounts payable to you. Therefore, one party, it is a financial asset, another party, it is financial liability. That is called financial instrument. And that right which provide you to receive the cash is called financial asset. Derivative contract which are favorable condition in the entity in you is also called financial asset. Derivative contract is also called a financial asset which are favorable to the entity. We can identify, understand in detail through this example. For example, building is appearing in your books. Is it financial asset? No, it is not a financial asset. Why? Because it does not provide the right to receive a cash to another entity. It building give us right to use, not right to receive a cash from other entity. Therefore, this is not a financial asset. Receivable from the other entity, from the customer. Yes, this is a financial asset because it provides the right to receive cash to you. Therefore, yes, this is financial asset. And how about inventory? You have in hand inventory. Inventory is a non-financial asset. Why? Because inventory does not provide any right to receive a cash from an other entity, other company. You have a right to keep inventory. You have a right to sell inventory, not right to receive inventory. It means this is not a financial asset, non-financial asset. Advanced taxes, receivable. Anything which is receivable from the regulator is not a financial asset because we have read there is a contract between two parties, financial asset, right to receive a contract which establishes the right to receive the asset. There is no contract with the regulator. They are enforced through the law. Therefore, advance tax is not a financial asset. It is being dealt by IAS 12. Therefore, it is not a financial asset. Loan given to someone. This is a receivable. This is you have a right to receive the loan on maturity. Upon the condition fulfilled, upon the completion of the term, yes, this is you have a right to receive the cash. It means this is financial asset. Rent advance. You have given the rent advance. Is it financial asset? No, you have a right to receive the services, not to right to receive the cash. Therefore, rent given advance is not a financial asset. This is a non-financial asset. Three-month security deposit given to the landlord is adjustable, not refundable. Adjustable means you will adjust against your rent. It means, do you have a right to receive cash? No, you have a right to make the adjustment. Therefore, the security deposit against the rent, which is adjustable, is not a financial asset. If this is a refundable, then you have a right to receive the cash. Then we can say this is a financial asset. Advance to supplier. There are credit balance. You have given the advance to the supplier. What is your right to receive from supplier? Your right to receive from supplier to receive the goods, not to cash. Therefore, advance given to the supplier is a non-financial asset. Intangible asset. You have an intangible asset you can use in your business. You can sell them. Therefore, there is no right to receive the cash from another entity, from someone. Therefore, this is non-financial asset. Investment property. You have land and building, hold for the purpose to receive a rent, to get the appreciation in price, or both. But is there any right to receive cash from anyone? No, you hold that. But whenever you sell it, then it will be converted into receivable. Then you can say there is a right. But the investment property in your books, appearing in your books, is not a financial asset. It is a non-financial asset. Capital work in progress. This is also non-financial asset, not a financial, non-financial asset. Investment and debentures, bonds, redeemable preference shares. It means upon completion of the term, you have a right to receive the cash from the issuer of debentures, bonds, preference shares. It means this is a, yes, this is a financial asset. Investment in golds. You have a gold, you have invested money and in the gold. Is it financial? No, this is also not a financial. Why? Because you have a gold, there is no right is being established to receive the cash from someone. Therefore, this is a non-financial asset. Investment in bonds, gold bonds issued by the Federal Reserve Bank and regulators and banks. It means, yes, this is a financial asset. You have a right to receive the cash by presenting the bond to the Federal Bank. Equity share held, yes, where cash and equity shares of the other entity is a financial asset. It means this is a financial asset, equity shares. Lease receivable, yes. Actually, there is a separate standard for the leases which tell us how the rental, how the lease assets should be determined. But the part of receivable being presented, being treated as a financial asset. Therefore, it is being clubbed under a financial asset. Anyone who have a question regarding the financial asset confusion and clarity, please do let me know so that I can explain it. Otherwise, I'm moving forward to the financial liability to have a in-depth understanding about the financial assets as well as financial liability. Please do let me know if you have any question. Need any clarification regarding the financial asset moving forward.
Hi, good afternoon, everyone. So, meanwhile, if somebody wants to ask any question, so maybe they can actually use the question answer box and they can ask the question, or maybe the chat box. Chat box is open.
Okay.
Thank you.
Thank you. What is financial liability? We have discussed the financial asset in detail. Now we come to the financial
There is
liability.
one, I'm sorry, there's a question actually from, which is related to the financial assets, where they're asking if the prepayments can be declared as a financial asset or not.
Okay, what is prepaid? Prepaid means we have paid in advance. Something prepaid rent, prepaid insurance, and what prepaid expense established for us to receive the insurance services. If we have prepaid rent, we have a right to use the premises which we have taken the rent. Okay, if we have get the car on rent, we have a right to use the car, not to write or receive. It means prepaid expenses are non-financial asset. Just like accrued income, this is a financial asset. Accrued income means you have rendered the services. No, there you have rendered the services, payment not yet received. Therefore, we can say accrued income receivable is your financial asset. Prepaid expenses are not financial asset because they does not establish to receive the cash. They establish your right to receive the services, or right to receive services, right to use asset against which you have make the prepayments. Is it okay? Yes, we have goods received but not invoiced. That is what it means. You have received the goods, invoices are not yet. It means you will have to goods in transit, receive a payable credit. That is your obligation. Goods are a non-financial asset, and there was an obligation to pay cash in future. That one side of the goods received is a non-financial asset. And the obligation, you have make the provision, you have make the accrual against the GIT, goods in transit. That is an obligation that will be paid. Also, revenue is not, there is a question, also revenue is not recognized, but the service is paid and completed. There, that is called accrued revenue because you have paid the services, you have rendered the services, but the revenue is not yet recognized. And you will have to make the accrual for that revenue. And that revenue will be accrued. That is, your right will be established. You will receive the cash in future. Okay. Contingent, contingent receivable, that is an asset. It means if there is a probable more than 50%, you are certain to receive the cash, you are certain to receive the claim, then it is called of your financial asset. Contingent liability, that is also probability to pay fair value. You know about the fair value of the contingent liability, and there is fair value can be treated as a financial liability.
That also also answers the question which has been asked just now about the contingent asset and liability. Just referring. Thank you.
Okay, okay, thank you. Financial liability, what is financial liability? Contractual obligation, obligation to deliver cash or to deliver another financial asset to the entity. If there is obligation established, obligation arises to deliver cash or to deliver other financial asset or equity instrument of the other entity, as well as own entity's equity instrument, that is called your financial liability. Or derivative contracts, which are unfavorable condition, not a favorable condition, is also called an financial liability. Now, there are some examples to understand clearly what is financial liability or non-financial liability. Loan taken, this is a financial liability. Loan taken is financial liability. Creditors, you have obligation to pay, to settle, to pay the cash to the payables to your vendors. It means this is a financial liability. Salaries payable, you have taken the services from the employees. It's no obligation to settle, to pay in cash. This is also financial liability. Credit balance of your debtors. Is it your financial liability? You have a credited balances. There may be some return, there may be some advances from your customers. The credit balance is appearing in the account of your debtors, of your account receivable. What is the obligation? Your obligation is to provide the goods or services, not to cash. It means you have a credit balance. In future, you will supply the goods and services to him. Therefore, this credit balance is non-financial liability. The debenture issued. You have issued the debenture. No, it's your obligation to pay the cash on the maturity. Debentures, preference share redeemable, as well as the bonds. If you issued that, all are called your financial liability. On the due date, you will have to settle it. Provision for income taxes. We have already discussed while we are discussing the tax, any relationship, any transaction, any payable or receivable with the regulator is not being treated as a financial asset, or if there is obligation, then they will not be treated as a financial liability. They are non-financial. As there is a separate standard IAS 12, which is dealing with deferred taxation related matters, as well as current and deferred tax. It means non-financial liability. This is non-financial. Security deposit refundable. When maturities come, they will refund you. It means this is a financial. Then you will refund it. It means this is obligation. On the completion of the terms, you will have to give the cash. There is obligation to pay cash. This is financial. If this is a non-refundable or adjustable, then it is a non-financial. If this is a refundable, then it is called financial liability. Contingent liabilities, guarantees given, fair value amount will be recognized as a financial liability. You will have to work out the fair value. Fair value amount will be treated as a contingent liability. Preference share capital redeemable. This is also like a loan. You have to pay, you have to redeem the preference share on maturity. Therefore, this is also financial liability. Dividend proposed. You have proposed the dividend to the board. Is it your financial liability? No, there is no obligation arises unless it is approved. It means proposed dividend is a non-financial liability. Dividend approved. No, it is a financial liability. No, you will have to deliver cash to the shareholders. There is an obligation. This is all about the initial regarding the definitions, regarding what is financial asset, what is financial liability. Now we will come to the IFRS 9. IFRS 9 deals with the classification, initial measurement, subsequent measurement, how to conduct the impairment test, how to do the hedge accounting derivatives like that. Now we are going to move forward to discuss the IFRS 9. This is the overview of IFRS 9. Classification, measurement, initial and subsequent. There are two tests we will discuss regarding the financial asset, contractual cash flow, SPPI, sole payment principal and interest, business model we will discuss. On those basis, we will decide which financial asset will be categorized, which will be fall in which category, which class. These two things will decide: contractual cash flow and business model. We will discuss in detail. There are three categories. In the previous standard IAS 39, there are 4 classes of the financial asset that are on rule-based. This is a very clear-cut methodology how to classify. To make the thing simple, IFRS 9 came into force. Therefore, 3, fair value through P&L. First class is fair value through P&L, fair value through OCI, amortized cost method, we will discuss in detail. Then impairment, how to conduct the impairment, which is expected credit loss, how to work out expected credit loss, when it will be lifetime, when it is 12 months, when will be we use the simplified approach, how to conduct the impairment in different categories. We will discuss hedge accounting, how to avoid the risk relating to your financial assets by using different hedging techniques, fair value hedge and cash flow hedge. We will discuss in detail. This is an overview we will discuss in IFRS 9. This is the classification we are going to discuss. Actually, we have 3 types of generally we have 3 types of the investment: debt investment, equity investment, as well as the derivative investments. Only 3 types of. If we are dealing with the debt investment, receivable, investment in debentures, investment in bonds, investment in redeemable preference shares, that kind of investments are called debt investment. For debt investment, we will apply contractual cash flow, and other name is SPPI, sole payment principal and interest. It means from this contractual cash flow means you will receive the principal and interest on specified date. What is the business model? Business model is intention to hold till maturity. If there is a interest and principal will be received by you, by the entity on specified date, only 2 cash flows. One is principal, other is interest payments. And management and entity's business model is to hold till maturity. But there are few exceptions. If there is a insolvency and there is a liquidity risk, there is a credit risk of the investment, then standard allow you to sell it. Otherwise, management intention is to hold till maturity. And entity will receive contractually cash flow means interest and principal on specified date. Then we will classify all those debt investment which meet the criteria of contractual cash flow as well business model, which is hold to maturity. We assign the amortized cost method for that investment. That will be classified under the amortized cost method. We will discuss what is amortized cost method later with examples so that we can understand it in detail. Hold and sell. You have a contractual cash flow plus an additional cash flow, which is a capital gain. Here there are 3 cash flow. One is interest and other is principal and third is capital gain. And your intention is to hold and sell, to hold some time and to sell to meet your upcoming future capital requirement like that. It means there is no intention to hold till maturity. You hold and sell it. If this is your business model, you have 3 types of the cash. One is interest and other is principal plus capital gain like that. Then you can classify that investment in fair value through OCI. This is another method. If there is a contractual cash flow test fail, then all that investment will be fall under fair value through P&L class. These three methods are for debt investment, investment in debt instruments. If you have investment in equity, investment in shares, then there is by default only one category. Whether it is long-term or short-term, you can classify that investment in fair value through P&L in this class. But standard provides you an option. If in case of long-term investment, if entity wishes to classify fair value through OCI, then entity can do. But once classified, initially designated in fair value through OCI, it is irrevocable, cannot be changed, cannot be reclassified. If there is a derivative contract, which is a favorable condition of the entity, all the derivatives will be classified fair value through P&L. For all types of derivative as financial assets will be classified fair value through P&L. Only one class for the derivative. Actually, there is only also one class for the investment in shares, but standard provide to you the option. If you want to classify fair value through OCI, you can do it, but standard do not force you. Standard give you the option for the long-term investment so that there is no significant variation in the statement of comprehensive income if you avoid the variation. Therefore, for the long-term purposes, you can classify fair value through OCI. Any
Mr.
question?
Ishfaq, there is one question from a participant. They're asking that how about the security deposit is received by the bank guarantee paper?
Yeah, you have given a security deposit. It means you have a right to receive on maturity. When the maturity come, when the security mature, then you will have a right to receive it. Security deposit, just like opening LCs and anything, you give the security deposit. That is not adjustable. They will refund you, they will give you. It means you have a right to receive cash on maturity. On expiry of LC, on settlement of LC, you have a right. If this is adjustable, then it is a non-financial asset. Clear? Contractual cash flow. What is contractual cash flow? Actually, the interest that cover the time value of money, credit risk, liquidity, as well as the profit margin, then we can say that this is a contractual cash flow, and that comprises of principal plus interest. Interest cover all the cost component along with the margin. What is business model? We have discussed there are three types of the business model. One business model is hold to maturity. Other business model is hold and sell. And third business model, held for trading, you can say. All types. There are three business model that is being decided by the management. How to recognition and measurement financial asset. This is the summary form. Initial recognition at fair value by applying IFRS 13 fair value. How to work out exit price, how to work out the fair value as per IFRS 13, and plus on initial regulation if the class is financial asset fall in class AMC, then we will how much is the fair value plus transaction cost. We will add transaction cost. That is called our initial recognition of the financial asset or present value of future cash flow by applying the effective rate of interest. In both cases, amount is the same. If there is a fair value through OCI, you have classified the asset fair value through OCI. Again, fair value worked out as per IFRS 13, then add the transaction cost into it. For example, fair value is 100, transaction cost is 20, then you will have to record a financial asset 120. This is meaning of this. If there is a model, you have choose this one, fair value through P&L, financial asset, fair value through P&L. Then transaction cost charged to the as a expense to the profit and loss account. It will not be capitalized. In both cases, you have capitalized the transaction cost to the asset. But financial asset classified fair value through P&L will be charged as the expense. Then we will only record financial asset to 100 and 20 will be charged to the P&L as an expense. Second, fair value through OCI equity instrument. Again, transaction cost will be charged to the profit and loss account, will be treated as an expense. Only 100 will be treated as a fair value, financial asset through P&L. How look like, how it will appear in statement of financial position. Amortized cost, fair value, it will appear at a fair value each reporting date. This will be reporting date, we will translate, we will bring it to fair value. This is also, this is amortized cost method. We will work out what is the value as per amortized cost method. That will be reflected in statement of financial position. What amount will be reflected in a P&L? There are three more you can look at. Effective rate of interest will be recorded as an income. And the interest received just only bank debit, asset credit, but the income will be on effective rate of interest, market rate of interest, and IRR based will be credited. If there is any impairment, that will also be charged to the P&L if you have classified the financial asset at amortized cost. Any foreign exchange differences, any foreign investment arises from the financial asset, foreign monetary being treated as a foreign monetary item, will also charge to the P&L. It means three things. If financial asset being classified at amortized cost method, you will treat effective interest income as an income in the P&L and profit and loss account. If there is any impairment, then will be charged to the profit and loss. If there is any gain and loss, if financial asset is a foreign monetary item, then it will be reflected in P&L. Likewise, fair value through OCI, effective interest rate will be treated as an income, will reflect on statement of comprehensive income, impairment, as well as any foreign exchange on if this is a foreign monetary asset. However, in fair value, any income, any dividend, any interest received, or any change in fair value will be reflected in the statement of comprehensive. Nothing will become a part of your investment. All fair value changes, all the income, all interest, dividend received from fair value through P&L will be charged to the P&L. Likewise, fair value through OCI, any change in fair value will reflect to the OCI, will not become a part of your profit and loss account, statement of comprehensive income. However, if you receive the dividend on investment from investment and shares, that will be reflected in statement of comprehensive income. But the fair value changes will increase your asset and will reflect in OCI, not become a part of your statement of comprehensive income. The gain on fair value will become a part of OCI. What will reflect in OCI in case of amortized cost method? Nothing will reflect regarding the financial asset appearing in amortized cost in other comprehensive income. Here, fair value will change, will reflect. Fair value will reflect in other comprehensive income. However, interest, impairment, foreign currency exchange differences will reflect in statement of comprehensive income. Fair value through P&L, nothing. All the changes, fair value and other changes will reflect in statement of comprehensive income. Here, fair value change will reflected or fair value changes will reflected in other comprehensive income, not a statement of comprehensive income. Likewise, other comprehensive, if this is a debt instrument, fair value through OCI. If this is an investment in debt instrument, any balance left at the time of disposal in OCI, which is relating to the investment in debt instruments, then that balance will be recycled to the statement of comprehensive income. Statement of other comprehensive income debit or P&L, statement of comprehensive income credit. If the investment in shares, you can see, if the investment in shares, there is some, you have disposed of the share, there is some balance left in OCI, maybe credit or debit, that will not be recycled to statement of comprehensive. That will be close to retained earning or general reserve, will not recycle to the P&L. Is it clear? Any question regarding this summarized form of recognition, where it should be reflected or not? Great. Actually, fair value through OCI category has been introduced in July 2014. Debt instrument measured at fair value. Initially and subsequent measured at fair value. And any fair value change will reflect in OCI. Other than fair value change, interest revenue, FX, gain and loss, impairment, recognized in P&L, statement of comprehensive income. This is the equity classification, fair value through OCI, contractual cash flow, not solely payment of principal and interest, securities, investment is not satisfied, not held, non-held for trading at initial recognition, fair value classified, equity instruments. You have an option. First option is through the P&L. If the P&L, if there is an option, if the equity investment, security investment, there is an option. If the entity want to fair value through OCI, they can opt it. But dividend recognized in P&L, any gain and loss other than fair value, any gain and loss on fair value will be reflected in OCI. This is the debt securities OCI. We have discussed in detail the debt securities in summarized form. Here are contractual cash flow, solely principal interest plus capital gain, and held and sale, not held to maturity. They may hold for some time and sell it upon the requirement of their expansion capital requirement. There is no intention to hold till maturity at the initially. Not irrevocable. Any balance left over in OCI will be recycled to the P&L. Here in investment is irrevocable. Once you have initially, if this investment in equity, then this will not, this is irrevocable. If this is a debt investment, it is not irrevocable. Now we will discuss what is amortized cost method, how it will apply. For example, you have deep discount. There is a market rate of interest. You have investment at market rate of interest. On 1st January 2001, J bought a deep discount bond for 50,000. Nominal value is 50,000. But however, the discount was 12% on nominal value. Transaction cost, TC, is 2,000. Interest rate, market rate of interest on nominal is payable annually. This is market rate, not subsidized rate. You have issued at market. Market is issuing in this pattern, in this way. The bond must be redeemed after 5 years. At premium, you will have to redeem at premium, which is 4,611. If any investment which is at market, then you will have to work out IRR, at what amount it should be recognized, or net how much transaction cost, what cash outflow you have to make the payments. For example, how much your cash outflow? 50,000 into 10% is the discount. It means 44,000 is your cash flow. You have make the payment. 2,000 is your transaction cost. This is a amortized cost method. You are classifying because your intention is to hold maturity. You have specified amount of cash flow on specified date, interest plus principal. Then it means your financial asset at amortized cost. You have classified. How to count for in our book, how to recognize in our books. It means your asset value is 46,000. Now, how to recognize as interest income? When the investment at market rate, then you will have to work out the IRR. What is the IRR of this investment? It means this is my cash outflow. This is my cash outflow. I have make the entry. Investment in bonds, 46,000. Bank credit, 46,000. This is the initial recognition. How much I should recognize interest income at the end of the year. That should be at IRR. You will have to work out the effective rate of interest, internal rate of interest, actual rate of interest, the same meaning. Everything is the same meaning. It means this is your cash outflow. You will receive 2,500 in first year, 25 second, third. This is the outflow. This is where you will receive at the end of 5th year, interest plus premium plus face amount. It means at what rate the net present value, IRR is equal to net present value of cash flow is equal to 0. The discount rate at which net present value of cash flow is 0, or discount rate at which cash outflow is the present value of cash outflow is equal to present value of cash inflow. We have worked out by applying a formula. This is the rate at which there is net present value is 0. You can see this is the present value of this rate. Present value, third, fourth. It means this is the present value of these cash flow today, present value of these cash flow, which is equal to initial recognition. This is our initial recognition opening balance. At the end of the year, you have earned. Interest is accrued, interest is recorded as interest income on IRR basis. However, interest received is 2,500. It means what entry I could do. For example, this is the financial asset debit by 3,951, or interest income credit by 3,951. This is the entry. For that effective rate of interest, income will be worked out, computed by applying the effective rate of interest on the asset initial recognition. It means how much amount we have received in this regard, 2,500. It means plus this one, interest, by interest, you will increase your financial asset, and how much you have received, this amount, decrease the asset by 2,500, closing balance would be, financial asset would be 47,451. It means you have taken the initially opening balance, adding interest income on effective rate of interest, reducing by the interest actually on face value, you actually, how much interest you have received will be reducing, will be deducting, will be subtracting from this, you will get the closing balance. Next year, this will become opening. Again, you will apply IRR, 8.59%. That is your interest income. How much you have received, this will be reduced, plus this one. Subtract this one, you will reach on closing balance 49,026. Again, this will become next year opening balance. Then again apply IRR, this rate of interest, effective. This income will reflect in your statement of comprehensive income, and asset will be increased. Asset debit, interest income credit. This you have received, this amount will reduce. Bank debit, financial asset credit. You will reach this one. And so on. Again, this one, again, this is the income plus this, how much receive, you will reach at 52,594. Again, this is your opening. How much interest you have earned this month? How much you have going to pay? You can say there is breakup is 50,000 is nominal value you have paid, and 4,611 is the premium, and the interest is how much is 2,500. It means this plus this, you can add, it will reconcile your whole payment. At the end, you will reach zero balance. Actually, you have received all the principal plus interest. It means interest will reflect on IRR basis, and asset is reduced by the how much interest you received. If we look at journal entries, you can, this is the case when you have made the investment at market rate. This is the journal entries. You can see initially investment in bonds, 46,000. Likewise, you can see here, initial 46,000, and including transaction cost, bank credit, then year end, first year end, you can see here, bank debit, investment in bonds or interest and interest income credit 3,051. You can see from here. Bank debit 2,500. Interest income on IRR basis is 3,950. And the difference will increase the investment in bonds, financial asset. Every year you will do the entry from this. You can take the entry from this table and reach at the end of 5th year. Every year you will bank debit 2,500, investment in bond 1,575, interest income 4,075. And 3rd year, same 2,500. A bank debit, investment in bond 1,711, and interest income that will reflect your statement of comprehensive income 4,211, and so on. You can do it. Is it clear? AMC method, financial asset classified under, this is only a typical method. You will have to understand in detail. Fair value is easy. If there is any question, please do let me know. This is slightly technical.
Mr. Shfaq, I'm sorry, but I think we are going beyond 1 hour. Which generally we keep it to like 1 hour, and I'm sure that it's not going to be completed. So we can actually just continue in the next session. But what do you think? How much time you would need to complete
Can
it?
you, so that I can complete first classification financial asset through measured at AMC, amortized cost method, only 10 to 15 minutes?
Okay, that's perfect. Perfect.
Then remaining standard, but we will only cover one method, but there are there are 2 to 3 methods left. Then we will discuss in later session, and also the change in classification, hatching will be left, impairment will be left. Actually, this is a full-fledged huge standard. At least there should be a 4 to 5 hours standard complete if we want to cover it in detail.
No, I clearly understand. That's what I'm saying. But anyways, let's try to finish this part, and then we can
Okay,
actually just go for the next session, of course.
okay, no problem.
Thank you.
Same question, but the financial asset is off market rate. Actually, you did the investment. Market rate is higher, but you made the investment at lower. Just like this is in order to differentiate, I make the same question practically. For example, you given the loan to the employee at the lower rate. For example, market rate is 15%. You give the loan to the employee only 5%, 2%. It means you are extending the loan to the employee. What entry should be made by the bank, by the company who is giving the lower rate of interest as compared to the market? In order to compare, in order to make the comparison, where I have took the same example as per previous, but taking the off market rate. You can see here, 1st January 2001, J bought a discount bond with 50,000 nominal value. Discount rate was 12% and transaction, these are the same, but interest rate is the same. But I have changed. Market rate is 15%, but we have only invested 5%. If this type of the investments which are lower than market rate of interest, because there are some hidden objectives, might be for retention, might be something else, then how to recognize that type of investments, that type of loans, that type of bonds investment? Okay. Same initial recognition is the same. For you can say how much cash outflow, 44 plus 2,000 transaction cost, then you will have no need to work out IRR. If off-market rate, you have make the investment at off-market rate, lower rate than the market rate of interest. That is called off-market rate of interest. Then no need to work out IRR. In previous example, we have worked out the IRR. Then work out the present value. Then no need for initial, then what would be the amount of the investment? What would be the amount of investment in AMC, where financial asset at AMC would reflect not 46,000. It should be by discounting that cash outflow at market rate. You can say this is the 2,500. When we apply 15% discount rate in first year, this cash flow will be present value. We have worked out by applying a discounting factor 15%. It means total present value of these cash flows are 35,532. It means I have to record the asset 35,532 rather than however, my cash outflow is 46,000. Where should I take the balance? Debit financial asset at amortized cost method, 35,532. Credit bank, 46,000. Where should I reflect the balance? Standard says it should be reflected at a prepaid expenses and will be charged over the terms of the bond, 5 years. If you don't have level 1 information about the fair value or the value, if you have a level 1 information, then it should be charged to the PNL. The 99% level 1 information is not available. 99% we will charge at a prepaid expenses and amortized over the bond terms. Therefore, we have taken this as, if you look at the entry would be like this: investment in bonds, present value discounted, cash inflow discounted at present value, discounted at market rate of interest. That amount is we have taken this amount, 35,532, and prepaid expenses 10,468, and bank credit. This is the entry you will make. And this 10,468 will be amortized, divided. It means what is the terms? 5-year terms. It means it will be amortized divided by 5. Each year, 2,832. Sorry, it will be amortized 2,094 as a PNL debit, prepaid expense credit. Remaining is the you have taken from the schedule. This is the effective market rate of interest will reflect in the as a income in the PNL. Interest received will reduce your financial asset. For example, we have recorded how to record this income. Financial asset, investment in bond debit by 5,330. And interest income will reflect in statement of comprehensive income by 5,330. And what about how much? What would be the entry of this one? Bank debit 2,500. Financial asset at AMC credit 2,500. It means plus this one minus this, we will reach at closing balance. Likewise, this become next year, this will become opening. Record the income at market rate, reduce the financial asset by nominal, how much interest you will receive, we will reach the closing balance. Then this will become the opening again, plus income you have earned at market rate, effective rate income. Then reduce the how much interest you have reduced, we will reach the closing. This is likewise the previous example. Whole story is like a previous. But difference is you will have to work out the present value of cash inflow at market rate. There is no need for IRR because we have already issued at very discount below market rate, off market rate. It means there might be some why we did issue off market rate, might be some other objectives. Therefore, we will have to segregate how much right we have to receive the cash, how much right we don't have received the cash. Prepaid expenses non-financial. Therefore, we need to segregate how much component is non-financial, how much component is financial. This is the entry. Therefore, we have segregated. We have worked out the present value of cash inflows at market rate, discounted at market rate. This is the how much cash outflow we have paid, total amount paid regarding this financial asset. The difference will be charged as a prepaid expense. This will be amortized over the term of the investment. Term is 5 years, divided 5. You can see each year, this is the P&L debit, prepaid expense debit. Credit, P&L debit, prepaid expense credit, P&L debit, prepaid expense, P&L prepaid. Each year, you can see here. And how much effective income will be recorded as effective income? 5,000 first year, 5,330. You can see from the schedule here, 5,000. This is a market rate, income credit. How much you have received? Bank, 2,500. How much investment in bond? Difference of both, 2,830. Next year, you have received the same amount, 2,500. Investment in bond, 3,254. Interest income that will reflect in statement of comprehensive income, 5,754, and so on. You can see here. This is the AMC method. Likewise, we can discuss the fair value, how the fair value method can be. Fair value through OCI in debt investment, fair value through OCI in equity investment. But due to the shortage of time, we are not able to discuss in detail. We may discuss in next session. And sorry for the delay start in the session due to some connectivity issue. And thank you for your patience you have shown and keen interest in understanding the financial instrument, how it will work for. And this is very important for the financial sectors, insurance sectors, as well as to some extent non-financial sectors. But the foundation of financial sector is very much based on this standard. Any question, please? Should we wind up or continue?
I think, sir, let's wind up for today. We can actually just announce the next session very soon, and that'll be really good. What do you think?
Yeah, no problem. Is there any question regarding when a few minutes I think we should spare for listening? Any question if there is something,
Absolutely. Let's give one more minute. If any questions, so we can still wait for that.
Okay, so that everyone on the same page. I think no question.
I think, yeah, there's no question. Absolutely, it was really good session, and I'm sure that everybody must have enjoyed. And we are going to have further sessions very soon, and we would definitely extend the next session. And we are actually going to have multiple series on the IFRS coming up. And I'm sure everybody would definitely enjoy the next upcoming webinars. Please stay tuned. One more reminder for everyone: 22nd November, we are going to have our annual IFA conference. It will be announced very soon. We have already shared all the information with the UK office, and I'm sure that everybody would start receiving the emails very soon. Let us know if you need any question. For getting the participation certifications, we have already shared the email address on the chat. You guys can actually just write an email and you can get the participation certificate for this webinar. Mr. Ishfaq, thank you so much for the time. Wonderful session, and I'm sure everybody must have enjoyed this session. Again, everybody, thank you so much. And next time, see you soon. Take care.
Thank you, my player. Bye bye. Take care.